Hello fellow investors and welcome back to my P2P portfolio update for December 2025. We have officially closed the books on another year and the P2P space did not go quietly into the holidays. Many platforms doubled down on end-of-year promotions and last-minute incentives. December for me raised some uncomfortable questions about risk, transparency, and what really matters when chasing returns. In this update, I will take you through how my portfolio finished the year, highlight the platforms that surprised me both positively and negatively, and revisit some of the developments that deserve a closer look, now that the dust has settled. Was December a strong finish or a warning sign going into 2026? Let's break down the numbers, the news, and the lessons learned. As always, I would love to hear your perspective in the comments. So, let's start with Income Marketplace. My current investment here stands at €7,665, and in December 2025 this position generated €66 of interest. All of my funds remain fully allocated across the available loan originators with no idle cash on the platform. During December 2025, Income Marketplace itself did not announce any major structural or business model changes. Platform operations remained stable, repayments continued as expected. In that sense, December was a relatively quiet month at the platform level, which is exactly what you want to see. As I have discussed in previous updates, I am in the process of reducing my exposure to Current Auto Lithuania and Current Auto Latvia. In my view, these remain among the weakest loan originators not just on Income Marketplace but in the wider P2P sector. The strategy here is unchanged. I am allowing repayments to gradually run these positions down rather than reinvesting into them. As a result, I fully expect my exposure to both Current Auto entities to continue declining over the next few months, exactly as planned. Income Marketplace remains operationally solid, but this once again highlights an important lesson in P2P investing. Platform stability does not remove originator-level risk. For me, Income Marketplace stays in the portfolio for now, but with a selective and increasingly conservative approach going into 2026. I'm continuing the process of winding down my investment on Lande. At the end of December 2025, my account balance stands at €1,546, and the platform generated €5 in interest. This lower monthly income reflects the ongoing reality of delayed repayments and the capital tied up in recovery. Looking at the portfolio statistics at the end of the year, the overall picture has not changed. The number of loans delayed by more than 60 days and those in default remains high, and while there have been occasional small improvements, progress continues to be very slow. Repayments are coming in, but only at a trickle, and patience is clearly required. This pace of recovery is broadly in line with my expectations for Lande and once again underlines an important point. This is a platform where capital can remain locked up for extended periods of time. Investors need to be comfortable with limited liquidity and long recovery timelines. From a platform communication perspective, December 2025 did not bring any major updates or breakthroughs. Lande continues to provide regular written updates on the recovery efforts, which I do appreciate, especially given my own professional background in debt collection. However, the quality and effectiveness of executions remains mixed. Issues such as missing collateral and poorly enforced security arrangements are still being referenced, and this highlights weaknesses in collateral management that should ideally be addressed much earlier. Despite the sluggish recovery process and significant number of problematic loans, I still do not expect to lose money overall on Lande. That said, expectations need to be realistic. This is unlikely to be a profitable investment in the meaningful sense, and at best I expect a slow exit with a small positive outcome once recoveries are eventually completed. My current holding in Fintown stands at €7,718, and in December 2025 this position generated €66 of interest. Interest payments continue to arrive smoothly throughout the month with no delays or missed payments. December itself was, as with other platforms, relatively quiet without many announcements. Again, this is a good development, and that's what we want: stable cash flows on a platform level. Overall, Fintown continues to be one of the more reliable and predictable platforms in my portfolio. December reinforced that view at this stage, and I see no reason to adjust my allocation going into 2026. The risk remains a steady hold for me, focused on consistency rather than aggressive growth. My Estate Guru position has continued to slowly decline and now stands at €2,760. In December 2025, the account generated just 2.38 euros in interest, which highlights how little productive capital remains on the platform at this stage. As you know, I'm no longer actively investing in Estate Guru, and simply withdraw any funds that become available before the inactivity fee is applied. This allows for a free withdrawal. Beyond the basic maintenance, there has been no meaningful activity in my account. December did not bring any updates that would materially change my view of the platform. Communication around recoveries remains limited, and there were no substantive developments that would restore confidence in Estate Guru's ability to resolve its loan issues in a timely or transparent manner. Estate Guru is the biggest disappointment in P2P investing so far. It serves as a clear reminder of how quickly a platform can deteriorate once underwriting standards weaken and recovery process falls behind. My focus here is purely on capital recovery rather than returns, and this position remains firmly in the wind-down mode. My current holdings in Inrento have increased and now stand at 12,395 euros. The position generated 112 euros in interest, once again without any delays or defaults. This continues to be one of Inrento's strongest points and reinforces its reputation for solid execution on the repayment side. During December, the account value fluctuated as projects were successfully realized and principal was repaid. This is normal and a healthy part of Inrento's investment cycle. Capital being returned is not a sign of stress, but rather confirmation that projects are reaching completion as planned. That said, December also once again highlighted the platform's biggest practical weakness: reinvestment friction. New opportunities continue to sell out extremely quickly. In several cases, projects were fully funded almost immediately after the notification email went out. December 2025 did not bring any major platform-level announcements or improvements to this process, so the situation remains unchanged going into 2026. Overall, Inrento remains a platform I trust in terms of asset quality, but one that actively caps how much capital I can realistically allocate unless the funding process becomes more flexible. My current holding in Buy Invest stands at almost 18,000 euros, and in December 2025, the position generated 174 euros in interest. Once again, Buy Invest delivered exactly what it has become known for in my portfolio: steady, predictable returns without surprises. December itself was a continuation of that trend. Repayments remained consistent, there were no notable disruptions, and the platform continued to operate smoothly. From an income perspective, Via Invest remains one of the most reliable contributors to my monthly cash flow. Unlike November, December did not bring any headline-grabbing operational updates, but that is not negative. The absence of negative news, payment issues, or structural changes reinforces the view that the business is currently on stable footing. At this point, Via Invest feels more like an income utility than a growth play, and that is precisely why it continues to hold a meaningful place in my portfolio. Overall, December further reinforced my confidence in Via Invest as a core, low-friction platform. I see no reason to adjust my exposure going into 2026, and it remains a key component of the portfolio for generating dependable monthly income. My current holding on Peerberry stands at almost 16,000 euros, and in December 25, this generated 99 euros in interest. Peerberry continues to contribute meaningful income to the portfolio. However, December once again highlighted some of the platform's ongoing usability challenges. I continue to experience issues with auto-invest functionality, which struggles to allocate all available funds effectively. As a result, I regularly have to step in and manually invest leftover balances. This undermines the convenience that automated investing is supposed to provide, especially on a platform of Peerberry size. There also remains a noticeable shift in Peerberry's loan mix toward longer-term loans. This trend continued through December and has a direct impact on how quickly capital can be recycled. With more funds tied up for extended periods, flexibility is reduced, which makes portfolio management slightly less dynamic than it used to be. December did not bring any major platform announcements or structural changes, so these limitations remain unresolved going into 2026. Overall, Peerberry still plays a solid role in generating income, but from a user experience perspective, it feels less streamlined than it once was. Esketit remains one of my larger positions, currently valued at over 18,000 euros, and in December 2025, this position generated 175 euros in interest. Despite the solid income contribution, my overall strategy with Esketit remains unchanged. I'm continuing to scale this position down gradually to a level that I feel more comfortable with, especially following the platform's poor handling of the operational move to Croatia. December did not bring any meaningful improvements or communication that would change my assessment, so the cautious approach remains justified. Esketit also participated in the usual year-end incentive campaigns, offering a 1% cashback on new claims purchased between December 10th and January 10th. While cashback boosts short-term returns, I treat these promotions with caution. They do not address the underlying operational concerns, and any cashback can be typically forfeited if you exit early. December itself did not bring any major updates from Esketit. Platform activity remained steady, repayments continued as expected, and there were no new issues reported. Still, confidence takes time to rebuild, and for now, Esketit stays in gradual reduction mode rather than growth. My current position with Astera Estate stands at 8,584 euros, and in December 2025, this investment generated 109 euros in interest. Astera Estate continues to be one of the higher yielding positions in my portfolio, but also firmly sits in the high risk category. I continue to follow the progress of the underlying projects through Astera's Telegram group, where regular short video updates are posted. These updates provide a visual timeline of construction, progress, and offer a level of transparency that many platforms simply do not provide. Being able to see tangible development week by week adds an extra layer of engagement and reassurance. That said, the elevated returns come with elevated risk. To manage this, I maintain my strategy of withdrawing interest monthly, gradually reducing exposure while locking in realized gains. Overall, December reinforced my view of Astera Estate as a high-yield, high-risk platform. For me, it remains a tactical allocation rather than a core holding going into 2026. My Ventus Energy account stands at 4,216 euros. The position generated 57 euros in interest. Ventus remains a high-yield, high-risk position. December did not bring any major new developments. The platform continued operationally normally, repayments were made on time, and there were no further public escalations. Ventus reiterated its commitment to transparency and to the independent audit that was previously announced, although no audit results were published before year-end. As mentioned before, my concerns here are not about short-term income, but about structural risk. The mezzanine loan structure means investors sit behind senior lenders in the capital stack, which significantly increases downside risk in a worst-case scenario. For now, Ventus remains a small, speculative position in my portfolio. I continue to monitor developments closely, but this is not a platform I would recommend to new investors. My holding on Afranga stands at 8,793 euros and generated 89 euros in interest. Afranga continues to show steady performance with repayments arriving on time and no negative surprises during the month. As with other platforms, December was operationally quiet, which is a good thing. There were no disruptions, no lender issues, and no changes to their business model. The platform continues to expand gradually while maintaining consistent execution. My goal with Afranga remains unchanged, to slowly grow the position until it produces around 100 euros in interest, without rushing adding capital onto the platform. Overall, Afranga remains a solid mid-risk contributor to the portfolio, and December reinforced my confidence in its steady trajectory. My investment with Nectara now stands at over 10,000 euros and generated over 100 euros in interest. Nectara continues to perform well, with Credit Prime Romania and Credit Prime Moldova remaining the strongest lender in my allocation. And December did not bring any major announcement on platform changes. Similar to Afranga, my objective here is to maintain a controlled increase in exposure until the platform delivers roughly 100 euros on a regular basis, which of course December already achieved. From here, any further scaling will depend on continued lender performance and overall portfolio balance. Going into 2026, Nectara remains a stable income platform for me, without headline excitement, but with dependable execution. Before wrapping up, I think it's useful to zoom out and look at how the portfolio has evolved over the last 3 years. Back in 2023, the portfolio finished the year at around 82,000 euros, generating just over 5,200 in total interest. In 2024, the portfolio grew to roughly 95,000 euros, and annual income increased to about 6,000 euros. Fast forward to 2025, and the portfolio now stands at 115,000 euros, with total annual income reaching over 10,000 euros. That's nearly double the income of 2024, driven both by a larger capital base and a more refined allocation strategy. What's interesting is that 2025 makes a shift in approach. Earlier years focused on growth, while this year has been much more about optimization, risk management, and income stability. You can see that in the way I'm now prioritizing predictable platforms, withdrawing interest regularly, and actively reducing exposure to weaker lenders. So while the numbers look great on paper, the real progress for me has been moving from expansion to control, from chasing yield to protecting capital. So let's wrap things up with a look how the portfolio finished in 2025. Total invested capital now stands at over 115,000 euros, and the portfolio generated 1,062 euros in interest in the final month of the year. This works out at an average annualized return of roughly 11%. That makes for a solid close to the year overall. That said, single month results don't mean much on their own. What really matters is long-term performance, capital preservation, and stability. With that in mind, I remain comfortable with the overall structure of the portfolio. The higher risk positions still make up only a relatively small portion of the total, and exposure is gradually reduced each month through regular interest withdrawals. Looking ahead to 2026, my focus shifts from growth to cleanup and consolidation, assuming market conditions allow. This will likely involve continuing to wind down both Lande and Estate Guru. Based on current figures, I still expect to exit Lande with a small profit, although patience will be required. Estate Guru remains more uncertain. Progress on recoveries continues to be slow, communication around problematic projects is weak, and there were no meaningful year-end developments that materially changed the outlook. At this point, my approach there is purely about capital recovery rather than returns. I also plan to further reduce my exposure to financially weaker lenders such as Current Auto Lithuania and Latvia, and continue scaling down Escatit towards a more comfortable allocation range. Overall, 2025 closes with strong income, but strategy going forward is clear. Simplify the portfolio, reduce unnecessary risk, and prioritize sustainable returns over aggressive expansion. One last thing that I wish to mention is the platform that stood out as a clear winner for 2025. For me, that is definitely Inrenta. Stable returns and steady cash flows, and so far no capital loss.